On the 19th of October 1987, the stock market lost 22.6% of its value in a single trading day. That is still, to this day, the largest single-day percentage decline in the history of American financial markets. The Dow Jones Industrial Average fell 508 points. $500 billion vanished from the value of American stocks. In one afternoon, there was no fraud, no scandal, no bank had failed. The economy was not in recession. A computer program sold too many futures contracts, which triggered other computer programs to sell, which triggered more selling, and more, and more. To this day, no one fully agrees on the cause. Let's rewind. By late summer of 1987, the Dow Jones Industrial Average had risen approximately 44% in a single year. The bull market had been running since 1982, 5 years of almost uninterrupted gains. It was fed by falling inflation, falling interest rates, and an economy that had recovered from the deep recessions of the early 1980s. The Reagan years had brought deregulation, corporate restructuring, and leveraged buyouts. Wall Street was profitable in ways it hadn't been in years. The culture had shifted. Finance was becoming glamorous. Gordon Gekko would arrive on movie screens in December of that year. The phrase, "greed is good," was about to enter the American vocabulary. On the 25th of August 1987, the Dow reached 2,722, a record high. By almost any measure, the market was at peak confidence. But underneath that confidence, several things were quietly changing. Interest rates were rising. The yield on the 10-year U.S. Treasury bond had climbed above 10%, historically significant territory. When bonds pay 10%, they become competitive with stocks as an investment. When bonds compete with stocks, investors shift money. Stock prices feel the pressure. On October 14th, the U.S. government released trade data, imports significantly outpacing exports, worse than expected. Markets slid that week. The Dow fell roughly 10% in the 5 trading days before Black Monday. Something had changed in the mood, difficult to name precisely, easy to feel. And somewhere in the data centers of Wall Street's largest institutions, computer programs were watching the same market data as everyone else, measuring, calculating, waiting for the signal to act. Between $60 and $90 billion in institutional assets were covered by these programs. Nobody fully understood what would happen when every one of them received the same signal at the same time. The answer arrived on a Monday. To understand Black Monday, you need to understand one specific product: portfolio insurance. Not insurance in the traditional sense, no policy, no premium, no insurance company. A trading strategy developed by academics at UC Berkeley, commercialized by a firm called Leland O'Brien Rubenstein Associates, or LOR. The idea was elegant. For any single investor, it was genuinely useful. Here is how it worked. Suppose you hold a large portfolio of stocks. You are worried about a potential market decline, but you don't want to sell. Selling would trigger taxes. You would miss any recovery. You want to stay invested. Portfolio insurance offered a third option: stay invested, but hedge using futures. A futures contract is an agreement to buy or sell an asset at a predetermined price on a future date. Stock index futures let you bet on the overall direction of the market. If you hold stocks and buy a short futures position, the two positions offset each other. When your stocks fall in value, your short futures position gains, canceling the loss. The portfolio insurance strategy adjusted this hedge automatically. As stock prices fell, the program sold more futures, increasing the hedge. As prices fell further, it sold more still. As prices recovered, it bought futures back, reducing the hedge. No human judgment required. The machine managed the risk automatically. For any single institution using this strategy, the logic was sound. You were protected against a market decline. The machine handled it for you. The problem emerged at scale. By 1987, portfolio insurance was not one institution's strategy. It was everyone's strategy. Between $60 and $90 billion of institutional assets were all running the same instruction. When prices fall, sell futures. Think about what that means. Every institution gets the same market signal. Prices are falling. Every institution issues the same instruction: sell futures. The exchanges receive an avalanche of sell orders in the same market at the same moment. Futures prices collapse. Futures and stock prices are linked, they track each other closely. When futures collapse, stock prices follow. When stock prices fall further, every portfolio insurance program receives the same signal again: sell more futures. The insurance had been designed to protect against the market. The market had been transformed by the insurance. On Friday, the 16th of October 1987, markets had already fallen nearly 5%, the worst single day in years. Over the weekend, institutional portfolio managers reviewed their positions. The logic of the programs was transparent. If Monday opened lower, more futures selling would automatically trigger. Some decided to get ahead of the programs to sell before the automatic selling began. The anticipation of the cascade was itself accelerating the cascade. On Monday morning, markets in Asia and Australia opened first. Hong Kong fell nearly 11% at the open. European exchanges opened sharply lower. By the time New York's opening bell rang at 9:30 a.m., there was already a global momentum building. The New York Stock Exchange opened in chaos. Many stocks couldn't establish an opening price. The sell orders so far outnumbered buy orders that specialists couldn't find a clearing price. Throughout the morning, the portfolio insurance programs triggered relentlessly. Falling prices caused futures selling. Futures selling caused stock prices to drop further. Stocks dropping caused more portfolio insurance triggers. More triggers caused more futures selling. The loop ran continuously, mechanically, without pause. Program trading computers automatically executing large orders based on predefined rules amplified every move. The programs were not coordinating with each other. They had never spoken. They had no awareness of each other. But because they all reacted to the same signal, in the same direction, at the same time, the effect was identical to coordination. By midday, the scale of the decline was becoming alarming not just to investors, but to the institutions underpinning the market. Questions were being asked about whether clearing houses could handle the volume of trades, whether credit lines between Wall Street firms would hold, whether the financial infrastructure of modern markets could handle a day like this. At 2 p.m., there were serious discussions about whether to close the exchange. Closing the New York Stock Exchange would mean every participant faced an unpriced market, perhaps even more terrifying than a falling one. The decision was made to keep the exchange open. By the closing bell at 4 p.m., the numbers were final. The Dow Jones Industrial Average had opened at 2,247. It closed at 1,739, a loss of 22.6%. In a single trading day, $500 billion had been erased from the value of American stocks. In 6.5 hours of trading, that Monday night, the question keeping everyone awake was simple. Would the financial system survive Tuesday? The answer depended on the banks. Banks had extended enormous credit to securities firms to fund their trading. If those firms couldn't repay because their positions had collapsed, the banks might stop lending. Without lending, the market couldn't function on Tuesday. Alan Greenspan had become chairman of the Federal Reserve just 2 months earlier, in August 1987. At 8:41 a.m. on Tuesday, October 20th, the Federal Reserve issued a short public statement. It said the Federal Reserve was ready to serve as a source of liquidity to support the economic and financial system. The statement was short. Its effect was large. Banks understood they would be backstopped. They kept lending. The market opened. The system held. There was no Great Depression-style aftermath. By the end of 1989, 2 years later, the Dow had recovered and exceeded its pre-crash levels. The feared recession never arrived. Black Monday is unique in financial history as a crash that produced no lasting economic damage. The Brady Commission investigated. Portfolio insurance was identified as a primary contributing factor. Circuit breakers were introduced, automatic trading pauses when markets fall too far, too fast. These circuit breakers remain in place today, a direct legacy of what happened on this single day. But no definitive single explanation for Black Monday has ever been universally accepted. Portfolio insurance amplified it. Rising rates pressured it. The trade deficit triggered nervousness. What Black Monday demonstrated more clearly than anything before it was that markets are not just places where buyers and sellers meet. They are systems, and systems can develop behaviors that no single participant intended or anticipated. Portfolio insurance was individually rational and collectively catastrophic. The machines were doing exactly what they were told. The disaster was in the instruction. Nobody committed fraud. Nobody violated any law. The market destroyed $500 billion on a Monday afternoon, and the damage was self-inflicted by its own design. If you enjoyed this story, subscribe for more finance disasters, market crashes, and billion-dollar mistakes that changed history. The next one is even crazier.